Welcome to the Wiser Weekly Roundup. This is a new series that we're going to do once a week. We're going to look at 5 topics in 20 minutes. And a lot of these topics come from conversations with clients as they're passing through, or phone calls that we have with them over the week. And I think that this is going to be a fun series. It's somewhat to be lighthearted, but also maybe a little informative at the same time. So, Brad, let's get started.
You know, we shouldn't have any trouble coming up with topics from week to week during the daily news cycle anymore. So it should be very fascinating to go through this.
Absolutely. First one on our list, cryptocurrency. I think that's amazing how fast this is moving. Crypto is basically unregulated at this point, but Coinbase was in the news in the last week. They were going public with an IPO. Now, Coinbase, if you aren't following this at all, is basically a trading platform for cryptocurrency. It'd be like your Schwab or Fidelity for stocks. Coinbase is for crypto. So if you want to buy Bitcoin, Ripple, Doggy Coin, all that stuff is going to be available on Coinbase, and their revenues are amazing. They were not profitable in 2020. I think they lost millions of dollars in 2019. In 2020, they've turned a profit barely. But I think it's with an accounting trick that they turned a profit. I don't know if they have actually free cash flow. But this space is growing. Upstart's another one that'd be interesting to see their progression as they move forward.
Not just growing, but it's almost growing exponentially as investors are adopting cryptocurrency as a fiat currency faster than I've ever seen investors adopt anything in the past. You know, the classic S-curve, Casey. You know, you have the early adopters, the mid adopters, and the late adopters. We're going almost straight up the line here on this one.
Well, what I think is interesting is J.P. Morgan came out with a Bitcoin recommendation for clients. Basically, it's like, don't buy it with us because there's really not a good vehicle. But 1% of your portfolio could be in cryptocurrency going forward, and that would hedge market movements, which is interesting because just a few months ago they said Bitcoin had no market hedge.
Well, as a cash alternative, cryptocurrency is fulfilling a role in investors' portfolios in order to preserve some method of exchange should the dollar, falter.
I think Bitcoin right now is around 48,000, between 48 and 50.
Well, I think it had a move yesterday. I mean, it's almost difficult to predict or even to quote a price on this anymore. It's over 50, I think, $50,000.
So if every corporation put 10% of their balance sheets into Bitcoin, the price would move to 200,000. Right?
That's an incredible move.
And we've got, I think it was Mass Mutual was predicting 400,000 would be the value in the next 5 to 10 years.
Yeah, I think they were basing that on the M2 money supply. So I don't want to get too much into the jargon, but they're trying to relate it on the money supply in the U.S.
Well, I'm still struggling with where it belongs in a portfolio, honestly. I think J.P. Morgan's stance is really mine. I had a friend of mine forward me that article, which was basically, hey, you've been saying this for a little while now, and we haven't said it publicly. This is probably the first time I've really talked about it, where in this environment anyway. But I'm still doing some soul searching on how it belongs in a portfolio. And I think a lot of advisors are. It's just so volatile, moving 20+% on a day very easily. You have to explain that to a client and why they should hold that long term, and how do you value cryptocurrencies, right?
Well, I wonder if these exchanges that are coming online, such as Bitcoin, will actually smooth out the volatility on a daily basis as more buyers and sellers come to the exchange to buy and sell this.
Yeah, that could be years away though. If corporations are really going to house balance sheet type things in it instead of cash, so interesting. Got to stay on top of it for sure. which kind of is a good segue into our next topic, electric vehicles. So what caught me by surprise, I guess a couple of weeks ago or last week, was Volvo announced they'd be in a completely electric car company by 2030, which, ironically, I kind of feel like of all the cars, Mercedes, BMW, I feel like Volvo is almost irrelevant. And there's probably maybe some Volvo drivers that love their Volvo, and that's great, but they're not what they used to be. I remember my parents had a Volvo 240. It's a box, really safe. It's like a tank on wheels. Safest car on the road. I don't know if they're still the safest vehicles or not, but their design has gotten better, I guess, after they got sold from Ford. But I don't drive by a Volvo dealership and go, man, I got to have one of those.
It's a bold statement for a company to come out and say that they're going to completely change the way they manufacture automobiles and go from combustion engine to an electronically charged vehicle in less than 10 years. I mean, this is 2021 now. We keep forgetting this, how fast time is moving.
In my mind, it's still 2000 for some reason, but we're not in 2000 anymore. It's 2021. So in the next 9 years, Volvo, you will not be able to buy a Volvo that is powered by a combustion engine. That's
and what's
crazy.
Interesting to think about is, were they being conservative in that estimate? It
may
be sooner.
Well, they said in 2025 they wanted to have half their fleet being offered using all electric. And then Jaguar came out and said that all their cars, talking about a car company that's irrelevant. I think Jaguar is another one. Jaguar is going to be all electric by 2025. GM today, right? You showed that to me this morning.
Came out at the end of January. GM has said that their entire fleet will be electronic vehicle by 2035. Now, they have many more brands than a Volvo, which is a single brand, a Jaguar, which is a single brand, a Tesla, which is a single brand. They have to convert every single manufacturing site, and I think they can do it by 2035. It's almost as if it's not that the company isn't changing fast enough, but they're kind of waiting almost, it feels like, for the consumer to pick up with this. So if Volvo had mentioned they can have half their fleet by 2025 and all of it by 2030, seems to me that they may just be waiting for the buyer.
I mean, yeah. I also think maybe ownership wants to chase that Tesla stock price, and if they're also all electric, maybe they hope to get the same valuation that Tesla gets somehow. I don't know. I was on Tesla's website last night building my own S-Type. And for $150,000, man, I get a really fast car. I mean, it's the fastest car, probably production car on the road, if I had to guess. It was at 0 to 60 in 1.9 seconds on their on their top end S-Type. I mean, that's pretty cool. But I don't know. I'm not really built for speed. I mean, we're a suburban family, right? We have a Suburban. It's hard to imagine a Suburban powered by electric, but I guess it's possible. Who's making the batteries for all these cars?
And where do we get them charged?
I mean, is Elon Musk going to sell all his batteries to GM and Volvo and Jaguar? Or are they going to have to start developing their own batteries? I have so many questions that none of these articles cover right now.
Well, what's interesting about these first two topics, so they have a common theme that I just thought of. It's innovation. We're seeing innovation at one of its most rapid turnovers that perhaps in a very, very long time. Electronic vehicles, fiat currencies, et cetera. I mean, this is an amazing time.
It's going to be interesting to see what BMW, Mercedes, and Porsche do. So they're kind of the leaders in innovation in the past, and what are they going to be able to produce? So I don't know. Maybe our cars in the parking lot right now are going to be antiques in 9 years, or we're going to be looked down upon because we have to stop at a gas station. So I don't know.
Vehicles today have a very long life, much longer than before. So it'll be how quickly will society change over these vehicles that are still workable, still working order, but they want to get a different, propulsion mechanism in there.
I have a hard time charging my phone so it's ready to go in the morning. I can't imagine trying to remember to plug in my car.
Don't trip over the cord.
Or like driving all over town looking for a place to plug my charger or plug my car into.
Yeah, can you imagine family members unplugging one car and because they need their car plugged in and charged in a hurry.
Yeah.
The other person going out is trying to start it up.
I mean, it's
low charge.
It's clean energy on one side, but it's dirty to make batteries. Making batteries is a not environmentally friendly process. So it's going to be interesting to see how that's solved, and where do these old batteries go when they're at the end of use. So I don't know. Maybe we all just lease cars. I really don't have any interest in buying a electronic car. I don't, because in 3 years, it's going to be obsolete.
Some of these low priced ones are very small. We're not used to driving around in little cars. We like big cars.
Right. So, all right. Well, let's move into something that we know more about. So ETF inflows. Last month, we added, let me look at my notes, $4.7 billion a day flowed into ETFs in the month of February. That's amazing. $88.7 billion in the month.
Yeah, I think that was the second highest month inflows on record. That's a lot of money flowing into ETFs.
And where did that money go?
It's going across the entire spectrum.
Exactly.
Fixed income, equities, international, domestic.
But the majority of it went to the S&P 500 in three funds.
Yeah, that's
VOO, IBV, and SPY. Those were all three funds that took the bulk share of that money going in.
Investors are looking for broad coverage in their investment. It is extremely difficult to pick a stock and pick a winner at the same time.
Well, yeah, there's that, but I just wonder what's driving it, because we're at all-time highs. So either this is the part where people start buying in at the high, right, because they have the fear of missing out on these great returns, right? I think I sat down with a client yesterday who's 80-20, 80 stock, 20% bonds. I think the rate of return was nearly 27% over the last 12 months. I mean, that's insane. They're like, can we get this every year?
But we know that savings rates are at an all-time high right now.
That's
true. I think
I
saw a metric that 15% of total financial assets are still in cash. That's at an all-time high.
Right.
So that cash is going to be deployed. And if investors are concerned about risk, the best way to go is into the broad index.
Yeah, and we also realize that bonds aren't going to do much for us other than stabilize a portfolio over the next 10 years at this point. So I certainly see people going to the stock market. Inflation, we're starting to see some inflation, signs of growing inflation. If that were to happen, the best place is the stock market.
It is. Stocks tend to do well in the early phases of inflation increases.
I think a lot of this money is institutional money. I don't have a basis for that right now, but I think a lot of this money is institutional money, and it's shifting. It's just shifting gears, if that makes sense.
It does. It may be repositioning after the year end. Boards and trustees that manage these monies, they don't meet on a day-to-day basis. They meet on a periodic basis. So now that the year is over and they're looking at their past year, looking forward now, they may need to be shifting money in order to take advantage of the future.
Yeah, I can see that. Well, next topic, gas prices. I filled up recently. I think it was almost at $3 for premium. Maybe it was just over $3 for premium. I don't know if I was in a bad spot to buy gas or not, but I've noticed a little uptick in the cost to fill up my vehicle. So I went on Y charts. We can throw that up here on the screen. So the Y charts, you see in this 3-year chart, you can see where we all stopped driving during COVID. So we see demand for gas fall. Then all of a sudden we see the demand increase, right? My commute across town to drop the kids at school and then come into the office suddenly has grown by 20 minutes. So at least in Cobb County, I don't know about the rest of the world, and probably Texas, since we just opened up Texas today. But I know in Cobb County that more people are on the road. And so you see that. You see decreased demand, decrease in price. Now you see increase in traffic. And now you see an increase in price and of the stock. I saw somewhere online that it was the Biden administration wants high gas prices to fuel new energy, and maybe that's true. I don't know that they can really control it that much, but certainly it's supply demand right now that I think is driving it.
It is a lot of supply and demand. Gasoline has a very high propensity to move with economics in terms of, as the economy is growing, there's a much higher demand for airline fuel, gasoline for automobiles. People get out and they move around. They've been stuck at home for a long time. I'm noticing it in my commute. There's more traffic out there these days than there was, in March, April, May, and June. So, and then you have the increase in demand coming up in the summertime, which
Yes.
isn't that far away. People are beginning to make plans. Refineries switch over to a different type of product for summertime. So, and then of course, gasoline is highly correlated to the price of a barrel of oil, and that's up over $60 now.
Yeah, I think we fell below 20.
Yes, way back in March, it was well below 20. Now it's up over 60, and it's kind of a good thing and a bad thing all at once. Our country is still heavily dependent on oil for energy. As oil does well, the ripple effect of the energy industry in terms of small businesses that surround it, suppliers, drillers, riggers, etc., they all do well during that time. So it's hard to pay at the pump, but it's generally good for the economy.
Another indicator is vacation properties. We were fortunate to, think ahead just after Christmas and secured our spot over the summer for our family vacation. But man, I've been talking to some clients. They're having a hard time finding good places for the beach. And I think people last summer who didn't take vacations were like, "Dadgummit, we're going on vacation this year."
I think that's right. In fact, we experienced a very similar thing. I booked a vacation for May, and since then I've gotten back on the Airbnb site, and the price of the place that we're staying has gone up dramatically. And I can only imagine it's because of the demand for time in these individual locations at lakes, mountains, ocean sides, etc., is just skyrocketing.
Yeah, I can imagine campgrounds. I mean, people are no longer going to be staying at home. I know that the COVID counts are coming down, but I think even if the COVID counts were going up, I think people were just over it at this point.
I would agree with that.
At least in the southern states.
I know we are.
At least in the southern states. And then with Texas, Florida, I feel like Florida's been open the entire time. But with Texas opening up, Mississippi opening up, no restrictions. Other states will soon follow, except for maybe New York and California and New Jersey. They'll probably stay shut down.
Yeah.
All right, last topic, Twitter. So we covered this in one of our podcasts. It's a podcast covering Section 230 of the FCC code that allows
it allows these platforms to limit
social
or eliminate their liability for the information that's being published.
Yes. So if Twitter produces or Twitter cannot get in trouble for the content that's put on their platform because of Section 230. So anyway, we have a whole podcast on that. I'm stumbling all over this, but we had a whole podcast on that just a few weeks ago. One of the things that we said in that podcast was, if Section 230 goes away, Twitter, Facebook, these companies are going to have to increase their revenue in order to police their platforms. Very interesting in the news, I saw that Twitter is going to start a subscription service that basically it I guess it's hard to explain because the world's trying to still figure this out, but essentially it's like a super subscriber service. So you pay $4.99 a month, and anytime this person that you're following sends something out, you're the first to know about it, or you get special tweets sent to you just from this service that you're subscribing to. I could see celebrities maybe doing it, or businesses, things of that nature. But I just, it's not advertising directly, I guess. But I just thought that was interesting, and I wonder if it has anything to do with the fact that Democrats and Republicans are upset with social media for different reasons. both of them threatening to strip out their protection of not being sued over content.
Well, to your point, if that's the case, that they're concerned about the Section 230, is that they need more revenue to beef up their staff to, in fact, police more of these tweets that are going out.
Right.
Exactly. So it's not as if the person tweeting is getting this money. It's the company that's packaging this group of tweeters.
Tweeters, yes.
Content that you are
producers.
subscribing to, and you have a preferred listing. And people who subscribe to it, I don't believe that they don't get the other tweets from everybody else that are public. They just get these others tweets that they're subscribing to in a very focused manner, and I'm sure they'll be presented to them somehow that's unique and different.
Right. Well, more to learn there for sure.
That's certainly something out there. And we're seeing social media change. They try and monetize their service in a much greater way.
All right, Brad, this was a great start to our weekly roundup, and thanks for watching. Watching our first production. Please be sure to subscribe to our YouTube channel at Wiser Wealth Management, and we'll see you next week.
Great.